This is Chris from Stockspot, and if you're like the 20 million or so Australians with a super fund, this video is for you. It's about the 3 things I think you need to be doing right now to see if your super fund is the right one. And the first thing I'd be doing right now is finding out how your fund performed over the last 12 months to the end of June 2025. What you need to know is that a very simple portfolio, just investing into 70% shares, 30% bonds in a passive or indexed approach, returned about 12% over that period. So if your fund has returned more than 12%, it's probably done well by picking a better asset allocation, maybe a higher risk asset allocation it's in, or maybe it's correctly timed buying more US tech shares or something like that. Or if it's returned less than 12%, you've got to ask it why as well. Has it been investing too much into private assets? Now, has it taken an active approach and it's not working? But 12% in my mind is the benchmark for this year. If your fund hasn't earned 12%, they would have been better off not having any fund managers there, any CIO, and just putting all of that super money into very low cost index funds. And if they couldn't do better than that, then a good question for you to ask is why not? The second question I'd be asking, and you can usually find this on super fund websites, is what bets is it taking? So most super funds actually publish what their target allocation for their portfolio is, and then what their actual allocation is. And the difference shows the sorts of bets that fund is taking on markets. So it might have a target allocation, for instance, for Australian shares of between 30 to 50%, but it might be investing only 30%. And you've got to ask them, why are you only investing 30%? What do you know that suggests that you should be having less than everyone else in Australian shares? And the same goes for any other asset class. Some funds I'm noticing at the moment have a huge exposure to private assets like private credit, private equity, venture capital. Why do they have these asset allocations, and is it actually helping your performance? I think that's a very important question to ask. But the first thing you can really do is just go to the websites of these super funds and have a look for yourself. What are their views? What are their bets? What conviction do they have? And what track record do they have for actually getting these views right? Our approach at Stockspot Super is actually very different. We don't take tactical bets on markets. We just have a strategic asset allocation approach, which means that we're not guessing whether one market or one asset class will do better or worse. We have a more static approach based on a long-term return expectation, and so we're not chopping and changing as often.
Sorry for interrupting, but I'd like to take a moment to talk about my channel. Now, most people who watch my videos don't subscribe to my channel, which means that they don't find out about other videos I'm making, and it doesn't share the love with others who are interested in investing. So if you are interested in videos like this, I would encourage you to please subscribe to my channel so you find out more about the videos we're making here.
The final thing I think you need to find out about your super fund, and this is particularly important for those who are a bit later on in their careers and approaching retirement. So if you're in your 50s or 60s, this one's for you. You need to go and find out what your fund's allocation is to growth assets and defensive assets. And I'm not talking about what they're saying are growth and defensive assets, because what I see at the moment is that a lot of super funds have quite creative definitions of what constitutes a growth or defensive asset. A lot of them are categorizing property or infrastructure or private credit as defensive assets, where in fact they're quite risky assets to have in a portfolio, and they don't really meet the ASIC definition of a defensive asset. I'd be looking at how much do they have in cash and high-grade bonds and gold. These assets are true defensive assets and are going to give you some more cushion if share markets are volatile. And if you're later in your career and approaching retirement, you really need to be asking, is there enough defensive asset allocation within my super fund to help to cushion its performance if there's market volatility between now and when I need to draw down my portfolio? What I'm seeing is a lot of the big funds are showing high defensive allocations, maybe 15 or 20 or 30%, but actually if you look a bit closer, their allocation to bonds and gold and cash is very, very low, and so you may not see the level of defensiveness that you're expecting from those funds. And they're the 3 questions I'd be asking your super fund right now. You can either send them an email, you can go onto their website and check them out, but I think it's important that you get those questions answered to work out whether your super fund is the right one. And if you do want to learn about our approach at Stockspot to our asset allocation and how we characterize defensive and growth assets within our super product, you can go to stockspot.com.au/super and learn more about how we do things at Stockspot.